The stock market should have already broken. Every single warning light is glowing bright red. Households are absolutely drowning in debt. Corporate balance sheets are stretched dangerously thin. The real economy, the one you and I live in, is slowing down. And yet somehow, the stock market just keeps climbing higher and higher. So why hasn't the system cracked? Why is it acting so invincible when every historical pattern, every piece of data is screaming that a collapse is imminent? My name is the Capital Storyline, and I study markets the way a historian studies cycles. Because history doesn't repeat itself exactly, but it always sends echoes. And right now, the loudest echo in all of market history is unfolding right before our eyes. The truth is uncomfortable, but you need to hear it. The market is being held up by forces you never supposed to notice. Forces powerful enough to delay a crash, but not nearly strong enough to prevent one. Let's start with the most basic measure: valuation. Legendary investors look at something called the market cap to GDP ratio. Think of it as a simple measure of how inflated the stock market is compared to the actual economy. Today, the total value of all U.S. stocks is somewhere around $65 to $67 trillion. The U.S. economy? That's about $30 trillion. This gives us a ratio of roughly 215 to 225%. Now, let's put that in perspective. Right before the Dotcom crash back in 2000, that same ratio peaked at 110%. And even then, the market still collapsed by over 50%. Today, our valuation is double that. This isn't just a simple case of overvaluation, this is a structural detachment. The stock market is no longer reflecting the real economy. It's living in a giant bubble of its own making. Price-to-earnings ratios tell the same story. For decades, the S&P 500 traded at a healthy P/E ratio between 15 and 17. Today, it's hovering somewhere between 25 and 29. But the real danger isn't the average. It's the extreme concentration. A tiny handful of mega-cap tech stocks, the magnificent few, are being bid up to absolute perfection. You see Nvidia trading at a P/E of 50 plus, Tesla at 200 plus, and other AI-driven companies at sky-high multiples that defy logic. These valuations demand flawless, uninterrupted growth, year after year after year. But no company, no matter how great, can outrun gravity forever. So, this brings us back to the big question. Why hasn't the crash happened yet? The answer lies in three hidden forces that are propping this whole thing up. First, government liquidity and monetary expansion. Even without the official quantitative easing programs we saw in the past, trillions of dollars have quietly flowed into the system. Government deficits are massive, and the Federal Reserve is indirectly supporting them. This new money flows first to banks, to large institutions, and to asset owners. It's a modern demonstration of what's called the Cantillon effect. Assets inflate, cash holders are punished by inflation, and the wealthy grow even wealthier. Second, the AI profit boom. There's no denying that corporate profits in a handful of technology companies have soared thanks to the AI revolution. These giants now carry the entire weight of the major indices on their shoulders, propping up markets that would otherwise be faltering. Their success is extraordinary, but it also introduces an extreme, concentrated risk. If just one or two of these giants stumble, the entire system stumbles with them. And third, the dominance of passive investing. More than half of all U.S. stocks are now owned by index funds and ETFs that buy automatically regardless of price. This creates a dangerous feedback loop. Funds buy the biggest companies, which makes their stock prices rise, which increases their weight in the index, which forces the funds to buy even more. It works like magic when markets are going up. But in a downturn, these same funds will be forced to sell blindly, amplifying the crash on the way down. The system is also hiding risk in the shadows. After the 2008 crisis, new regulations pushed banks to appear stable and safe on paper. But the risky lending and the dangerous leverage didn't just disappear. It moved into the shadow banking sector, a $4 trillion system with minimal oversight. So while the big banks look safe, the real danger is just hidden from view. But a delay does not mean safety. Every major bubble in history follows the same psychological sequence. It starts with a period of euphoria that lasts far too long, then comes a numbness to bad news, where negative data is just ignored. And finally, a single event breaks the confidence, a major bankruptcy, credit freeze, or a shocking earnings miss from a key company. When that happens, selling accelerates, and the crash finally arrives. The longer this crash is delayed, the bigger and more severe it will be. Here's the hard truth. The market today is not built on productivity or innovation. It's built on confidence. And confidence is the easiest thing in the world to lose. When that confidence finally breaks, no central bank or government regulation can stop the chain reaction. The people who survive a crash are never just lucky. They are the ones who position themselves outside the fragile system, in things that hold real, tangible value, cash-flowing assets, land, productive businesses, intellectual property, and scarce commodities. The market hasn't crashed yet because a toxic mix of leverage, concentration, and regulatory loopholes are holding the illusion together. But the laws of financial physics don't change. You cannot expand claims on wealth forever without real backing. When the collapse comes, it will be sudden and only those who saw the structural weakness ahead of time will be ready to seize the incredible opportunities that are forced by liquidation. History has all the answers. You're living inside the next chapter right now. The only question is, are you ready to see it?